NAR releases its pending home sales figure today, and for the 8th month in a row, it's up. I'm Rob Freeman with Realtor Magazine, and I'm here with NAR's chief economist, Lawrence Young, to find out what's behind these numbers.
Today's data related to the pending contract showed a tremendous increase. The activity this September in 2009 is roughly 20% higher from 1 year before. So it's a tremendous increase. And on a month-to-month basis, it is an increase, also a solid increase, but this is a seasonally adjusted annualized figure just to comply with the government statistical data reporting. The actual raw count actually slid a bit, but the decline was much, much less than what we normally experience in September, which is the reason why September to September we had this big 20% jump. People are coming back to the market. It's the first-time buyer responding to the tax credit. They realize the deadline is closely approaching, and they are trying to meet that deadline.
So as we speak, Congress is considering extending the tax credit. What happens if Congress does not extend the tax credit before its expiration date, in your view?
The extension is required because what we want to have is a sustainable housing market recovery, and we are almost there. And to achieve that, home values must show consistent stabilization or modest increase. And given that prices have overcorrected, trying to nudge prices a little bit upward back to the fundamentally justifiable levels, we really need that to remove the consumer fear factor about the housing market. Then the buyers will buy based on normal decision process, changes in family circumstances, economic factors, and not the fear factor that prices may continue to drop. And I also want to address the one question that I've been actually getting from many of the realtor members and other people, which is, what is the difference between $8,000 tax credit versus $8,000 lower home values if we just let the market just adjust on its own? Well, there is a tremendous difference. From home buyers' perspective, maybe it's the same, $8,000 lower value versus the tax credit, but from the market point of view, $8,000 reduction in home values nationally on the aggregate, one is looking at potentially $700 billion destruction in housing wealth, mostly in the middle-class families, $700 billion destruction. And furthermore, that will raise foreclosures. So trying to stimulate demand to prevent that from happening, the $8,000 tax credit at a cost of roughly $10 billion to prevent a $700 billion wealth destruction, I think is a well worth effort.
So the U.S. Department of Commerce came out with its new home sales figures recently, and they actually went down. What's behind that?
The new home sales, as reported by the government, is not actual closing of the deal. It's actually contract signings. And the contract signings declined in September, while today's figure in existing home sales contract increased. So it looks like a little divergence. Maybe the data is not stabilizing. Maybe things are floating around randomly. But there is a clear explanation. First, existing home market today is more than 90% of all housing market. So one has to really look at the existing homes to assess the true housing demand. New homes is a very small market. The other component is that the builders have really cut back production. And if they have cut back production, there's very few new homes to sell. I mean, just simple arithmetic. If builders build only 3 homes, at most they can only sell 3 new home sales. So the builders have drastically cut back production, so automatically we will have lower new home sales activity. That does not reflect lower housing demand, but it just reflects lack of supply. And for the builders who also wants to build more to meet the supply, meet some of the demand that's coming onto the market. In some markets, well, trying to get that construction mortgage, construction loan is very difficult. So even for the builders who wants to build, they are unable to do so.
Well, the economy seems to be out of recession. Is this something that we can expect to sustain over into 2010, or could there be another downturn?
Right now, the outlook is very uncertain. And I think it all depends upon what happens to the middle-class Americans. And we have seen a spectacular rise in the stock market. But when one looks at the consumer confidence data, people are saying, I don't feel good. So we have seen no movement in the consumer confidence. It's at depressingly low levels. And I think the reason for that is that most people's wealth is not tied to the stock market. I mean, certainly people do have their retirement account, but large portion of most middle-class Americans, middle-class families, have their wealth tied to their housing. And as long as housing values decline, despite the fact stock market is rising, middle-class families will say, I don't feel good. And that's what we are seeing in the data. So if the home values was to continue to go down, then I think the economic recovery would be very shaky. But if the home value begin to stabilize or begin to increase, which provide that wealth for middle-class Americans, then I think we can have a durable economic recovery.